Okay. What's going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing some stock analysis on Sandisk Corporation, ticker SNDK. And before very recently, I was not aware of this company. Looks like it went IPO just over a year ago, and this stock is up 2,300% in the last year. That's it. It hasn't really gone up that much, but 2,300% is still pretty good. So we're going to see, what does this company do, and is this a good investment? Because obviously a lot of other people think so. So SanDisk engages in the development, manufacture, and provision of storage devices and solutions based on NAND flash technology. Its products include solid state drives, memory cards, and USB flash drives. And then if we come over here to Gemini, it says they are currently one of the most compelling stories in the semiconductor space. Following its spinoff from Western Digital last year, they relisted on the NASDAQ and rapidly transformed from a consumer grade memory card brand to a high growth pure play AI storage powerhouse. They are, let's see, blah, blah, blah. They recently experienced a sharp sector wide sell off sparked by Google's TurboQuant AI memory compression paper in late last month, which raised fears of reduced memory demand. However, the stock quickly rebounded as Wall Street analysts defended the space, arguing that cheaper inference typically drives higher aggregate usage. And that, I guess that makes sense. The fiscal Q2 2026 earnings report was a blowout driven by an accelerating AI inference cycle. The company reported GAAP net income of $800 million or $500 in diluted EPS. When evaluating the adjusted metrics, non-GAAP diluted EPS came in notably higher at $6, which I typically like looking at GAAP. This dollar divergence between GAAP and non-GAAP highlights significant non-cash expenses like restructuring and stock-based compensation, which I think is important to pay attention to, tied to the recent spinoff that are backed out of the adjusted figures, okay? Stripping away its low-margin legacy consumer baggage, SanDisk saw its gross margins expand dramatically to 51%. Now, SanDisk operates in the notoriously cyclical and capital-intensive NAND. I don't know if it's NAND or NAND flash market, but has carved out a highly defensible position. Their long-standing partnership with Kioxia is its most critical structural advantage. By pooling massive R&D and CapEx, the two companies share a cost structure that allows them to aggressively compete with industry giants like Samsung on next-gen architectures. While companies like NVIDIA dominate the processing side of AI, the training, SanDisk dominates the storage side, which is the inference. They are shipping massive AI optimized SSDs directly to hyperscalers like Amazon and Microsoft. Innovations like their HBF bridge the performance gap between standard and widely expensive high bandwidth memory, creating a highly profitable, high barrier niche for data retrieval during AI model inference. Unencumbered by Western Digital's legacy hard disk drive operations, SanDisk is hyper focused on flash innovation, which commands a premium multiple from institutional investors. Wall Street consensus is overwhelmingly bullish, fueled by reports that 2026 NAND manufacturing capacity is largely sold out, as we've seen with a lot of other companies like Micron, giving them immense pricing power. The median analyst price targets hover between 580 and 690. Okay, 580 and 690. We're past 700. The high-end targets are pushing towards the 1,000 mark, which again, this is just like Micron. I think Micron has very similar price targets even. During the parabolic run, their forward PE sits at a relatively modest multiple estimation. That's crazy. Okay, look at this growth though. 111% year over year this year expected, and then 72%. So they're going from $7 billion last year to 26 billion. That's crazy. Gap EPS negative last year, big time, and then up to 40 and then 100. Like, come on, that's just insane. I mean, I could see why this stock could be $2,000 or even $3,000. But the problem with that is that would make sense maybe like going into 2027. But then if their EPS goes back down to 50, well, then that stock price can go right back down to, I mean, it could still go to like over 1,000, though. It could go to 1,200 or 1,300 pretty easily. So, and it was the same thing when I ran the numbers on Micron. I did that analysis recently. It was the same thing. When you run the numbers, it doesn't look overvalued, which is crazy. It's just I wouldn't want to bet on that spike in earnings or in sales because I think just as fast as this is going up by 70 or 100%, I think it's also going to go down by that amount. I think it's going to drop 70%. I mean, I'm not sure what the demand and sales are looking like for 2028, but I would not be surprised if 2027 is the peak year for that business. And like they said, when more businesses come out with more supply or higher or better technology, it lowers prices and stuff. And but they're arguing that that actually increases demand. So I guess it's kind of a double-edged sword there with at the beginning it might cost more and only some customers can afford it, so sales are still rising, but then as soon as prices come down, well then now you have more, you're making less margin maybe, but now you have more customers, so you're still going to be making a lot of money. So it is very tough to value a company like that, but look at the last couple of quarters here, they've gone from right under 2 billion a quarter to now 3 billion a quarter. Free cash flow has gone from, it was negative, now they're about to do $1 billion of free cash flow in one quarter. Same thing with net income. Cash to debt right now is 1.5 billion to 500 million in cash, or 500 million in debt. I mean, shares outstanding slowly going up, which I would say that that should stop if they're profitable, but who knows? These companies are like putting so much into capex, it's crazy. Price to sales at an all-time high, would not pay 11 and a half times sales for a company. And free cash flow yield is 1%. That's not good. So it's just, I mean, pretty much the market's just pricing in what they're about to do. And so it looks so undervalued and so overvalued at the same time because for their numbers right now, it looks really overvalued. For the numbers they're doing next year, it looks undervalued. And then for 2028, 2029, it's likely that those numbers are going to come down big, and then you got to price that in too. So you got to think, okay, what is this company actually going to make over the next 3 to 5 years? So I mean, I would say this run up in the stock price is justified. It's just once you start getting to these high numbers, like $1,000, you have to say, okay, where are we? It becomes riskier and riskier to invest in that. So, as much as this is an interesting phenomenon that's going on with these companies in this industry right now, I would not be buying at this valuation. If you bought this at like, I don't know, $500 or less, really under $500, then that would have been a better risk to reward. But I don't want to pay 11 times current sales. So for me, this is not a buy at the moment. This is probably, at this point, I would probably sell most of it. I would maybe hold some and then sell the rest of it. But let me know what you guys think down below, and I will see you in the next video.